Now, you debunk the big myth about fiat money, the erroneous notion that printing money will lead to harmful inflation. Do explain, and also, if you take this tool away from central banks, you're trying to limit what they can do, right?
No, I actually want to give the power to central banks. Let me explain. Essentially, I think we've got so much debt in the world that we're not simply going to grow our way out of it. And that is an analysis completely consistent with what economists such as Ken Rogoff have written, and both in his book and in various articles with Carmen Reinhardt, etc. I think we have so much debt in the world that one of about three things is going to have to occur. Either we're going to have to maintain interest rates below the rate of inflation for a long, long period of time to erode that real value of debt. But with the irony that while that will help erode the existing debt, it creates incentives to make a whole load of new debt creation in the future. Or we're going to have large explicit debt write-offs, people actually default on debt. We'll have some of that. I mean, Greece is not going to repay all the debt on its balance sheet, let's be clear about that. Or we have to have what people call monetization, where the central bank buys government debt, and not just temporarily, but tears it up, does it permanently. Now, I think we've got to debate the relative role of these different things. I'm worried about the first one, as between restructuring and monetization. I would respect people who say it should be primarily restructuring and default, but there are disadvantages with that as well. But the starting point of sanity in this debate is to look at the amount of debt in the world and understand that it's going to be one of these three. We're not just going to, magically grow out of it. In that environment, I don't think we should exclude what I call overt money finance, and what Milton Friedman, a man whom I would point out was not a mad left-wing socialist nor an inflation lover, what Milton Friedman called helicopter money, which is the central bank actually printing fiat money to expand the economy and to make sure you hit inflation targets. Now, in technical terms, it is absolutely clear that a central bank could do an exercise in retiring current government debt by buying it and ripping it up, or could print money in a Milton Friedman helicopter money exercise, and there are no technical reasons whatsoever why that will lead to hyperinflation. If you did a very small amount of it, $10 million, you wouldn't even notice it. If you did 10 billion, you'd have a somewhat stimulative effect. If you did 10 trillion, you'd produce high inflation. If you did 100 trillion, you'd undoubtedly produce roaring hyperinflation. This is a tool where the impact will depend on how much you do. And if anybody says that's not true, I think they simply have not done the work of analysing it technically. But what is absolutely right is that there's not a technical risk here, there's a political economy risk, which is once we break the taboo and admit that it's possible, what's to stop the politicians saying, well, you told me 10 billion would be useful, but I'd like to do 50 billion. I'd like to do 100 billion because it's coming up to an election and I'd like to stimulate the economy and give my constituents some benefits. And that's why I actually have argued, not that we should take this tool away from central banks, but that we should precisely give it to central banks. That central banks pursuing inflation targets, such as 2% plus or minus 1%, should have the power to say to government, we're suffering a deflationary problem, and in this environment, the best way to get back up to 2% is to have X billion of money finance deficits, Milton Friedman helicopter money drop, but with the central bank given the complete power to say the maximum of that can be done. I don't want this power to be at the discretion of politicians because, like other people, I think they may well misuse it. But I do think that it should be an available tool for central banks to agree the maximum amount of this that there should be.
So they're your choices of imperfections.
There are fundamentally two ways to produce a growth of nominal demand within an economy. And we often don't think about this, but I think it's important to go back to the absolute basis of them. Either you have an expansion of what's called sovereign fiat money, the stuff that only governments can create, which is either the notes and coins in our pockets, or it is the reserves, which are the liabilities of the central banks. And those are fundamentally created by governments running fiscal deficits and funding it with money, not with interest-bearing debt. That's one way that you get a stimulus to nominal demand. The other way you get a stimulus to nominal demand is that private credit grows, and that stimulates nominal demand because, crucially, banks don't just take existing money and lend it on, they create credit, money, and purchasing power. These are two ways to expand nominal demand. Now, basically, what our dominant philosophy has been for the last 30 or 50 years is that we should have an absolute taboo against sovereign money creation, the monetary finance of fiscal deficits, but we were totally relaxed about whatever the private sector did in terms of how much private credit and money and purchasing power it created. And what I end my book saying is we have got to recognize that both of these things are dangerous. One or other is required. We should not treat private credit creation as something which we can completely rely on the private sector to get right. We need some of it, but we need to control it. Nor should we completely exclude in all circumstances some monetary finance to create increased sovereign money. We are caught between the dangers of out of control private credit creation and the potential devil of the misuse of sovereign money creation, and we have to recognize the risks on both sides and to use both tools, but to control the risks on both sides.